Hi everyone. Today I'm planning to discuss an examination question with regard to performance management, that is on ACCA F5. So here, what we discuss here actually a question or past paper question that is appeared in March or June to give an understanding as to how to approach a break-even analysis question from F5 level. So, if we go to the question says that the ACCA Hotel is situated in a major city close to many theatres and restaurants. The ACCA Hotel has 25 double bedrooms and it charges guests of $180 per room per night, regardless of single or double occupancy. The hotel's variable cost is $60 per occupied room per night. The ACCA Hotel is open for 365 days a year and has a 70% budgeted occupancy rate. Fixed costs are budgeted to be $600,000 a year and accrue evenly throughout the year. During the first quarter of the year, the room occupancy rates are significantly below the levels expected at the other times of the year, with the ACCA Hotel expecting to sell 900 rooms occupied room night during quarter 1. Options to improve the profitability are being considered, including closing the hotel for the duration of quarter 1 or adopting one of the possible projects as below. So, project 1 for quarter 1 only, the ACCA Hotel management would offer guest theatre package couples who pay for 2 consecutive nights at a special rate of 67.5 per room night. Will also receive a pair of theatre tickets for a payment of $100. The theatre tickets are very good value and are the result of long negotiation between the ACCA Hotel management and the local theatres. The theatre tickets cost the ACCA Hotel $95 a pair. The ACCA Hotel fixed cost specific to this project, marketing and administration, are budgeted at $20,000. The hotel management believes that the theatre package will have no effect on their usual quarter 1 customers, who are all business travelers and have no interest in theatre tickets, but will still require their usual rooms. So project 2, the restaurant. There is a scope to extend the ACCA Hotel and create enough space to operate a restaurant for the benefit of its guests. The annual cost, revenue and the volumes for the combined restaurant and hotel are illustrated in the following graph. So they have given you a conventional break-even chart which explains you how much is the revenue, the total cost and the fixed cost. The graph does not include the effect of the theatre package offer or after the theatre package offer. Required using the current annual budgeted figures and ignoring 2 proposed projects, calculate the break-even number of occupied room nights and the margin of safety as a percentage. So what we will do now, so if you look into this, the first requirement is actually to work out to calculate the break-even point with no implication of those 2 projects. So the equation for break-even point is equal to fixed cost divided by contribution per unit. Now, as we know that the question is given us the fixed cost. Fixed cost is 600,000. And now we need to calculate the contribution. So we have to find out the selling price. The selling price given in the question is $180 per room night. And then variable cost also given, which is $60 per night. So we can then calculate the contribution. The contribution will be $120. That is calculated. Now we need to calculate the break-even point. As we know the equation, fixed cost divide by contribution per unit. So therefore, my fixed cost is 600,000. That I divide by 120. Answer is 5,000. We can just reconfirm this. 600,000 divide by 120, you get 5,000 room nights. Now we need to calculate the margin of safety. In order to calculate the margin of safety, we need to identify the given sales. The given sales, actually they say the hotel room is occupied 365 days and hotel has 25 rooms. So 25 rooms, 365 days. How many room days we will have in the year? We will find it out. 25 times. So that is 9,125. And they say that 70% occupancy. The hotel has 70% occupancy. That means times 0.7. So 6,387.5 rooms. So this is the given sales. Now the break-even sales we know, that is 5,000 room nights. So therefore, margin of safety will be minus 1,387.5 rooms. If needed, you can round this. What you can do is 1,388. You can do this, but better to keep it as decimal in order to help our calculation easiness. So this is the answer to the first part of the question. And now we need to figure it out the percentage. So to calculate the percentage of margin of safety in percentage, so you have to take the margin of safety divided by given sales times 100. So you have the margin of safety which is 1,387.5 and then given sales is 6,387.5 and times 100. So divide by 6,387.5 times 100, you get 21.72%. This answers the first question, which gives you 4 marks. Now second part, ignoring the two proposed projects, calculate the budgeted profit or loss for quarter 1 and explain whether the hotel should close for the duration of quarter 1 or not. So now we have to calculate the revenue for quarter 1. So they said 900 rooms, and no, before that we can do it in alternatively. I know the contribution per unit, which is 120, and the rooms we sold during the quarter 1 is 900. So therefore total contribution is how much? 120 times 900. You end up having 188,000. Whereas minus fixed cost, we need to take the fixed cost only for the 1 quarter. The total fixed cost given in the question was 600,000. So you need to divide this by 4. So you get 150,000. So therefore, you are ending up having a loss of 42,000. There's a loss. Purely from financial perspective, ignoring the given proposals, it is not advisable to close the hotel. what we need to do, we need to evaluate the implication of the given two proposals, and then we need to decide this. So this is the answer for the second part of the question, which you get 4 marks again. Calculate the break-even point in sales value of project 1, explaining whether hotel should adapt the project. Now when we go to the part C, now in part C what they are saying is the special selling price. Special selling price 67.5, but you need to buy this for 2 nights. So number of nights, should be 2. So the total selling price will be 67.5 times 2, that you get 135. But not only that, the customers also need to buy the theatre tickets, that they sell it for 2 people, so 100. So the total sales value is 235. Now for this, we need to figure out the variable cost. So what are the variable costs we have? We have variable cost for room, that is $60 per 1 day. So 60 times 2, so I have 120, and then theatre ticket, that is 95. So the total variable cost will be, I believe you all of you understood that 60 is the variable cost per night, and then for 2 nights 120. So therefore 120 plus 95. So your total variable cost is 215. So therefore contribution per unit will be 20. And here interesting information about the fixed cost. From the ongoing existing business, the company already incurring fixed cost of 600,000. That fixed 100,000 has no relevance to this. They are specifically saying that information here. The hotel management believes that the theatre package will have no effect on their usual Q1 customers, who are all business travelers and who have no interest in the theatre tickets, but will still require their usual rooms. So in calculating the project for theatre, the relevant variable cost, relevant selling price and relevant fixed cost only we need to take. Hence the fixed cost here is 20,000. Therefore break-even point will be, as you know the equation, fixed cost 20,000 divided by contribution per unit, which is 1,000. So 1,000, this is room nights. Now what is the question they are asking? Calculate the break-even point in sales value. So we need to find out what is the sales value. So the selling price for this special project is 235. Therefore you get 235,000. Then what they are asking? For the break-even point in sales value, and explain whether the hotel should adapt the project. Now if you see the break-even point here, the actually the contribution compared to the total sales price, it's very low. So the contribution per unit is very low, and therefore in order to break even, we need to sell large number of rooms. We need to sell large number of rooms. If you see what is my annual budget, annual budgeted room sales. In our previous calculation, we got that out. We found out. Where is that? It is somewhere here. See, 9,125. That's our budgeted sales for the year. So then for first quarter 1, it will be 9125 divided by 4. So I am having 2000, how much? 281.25. And they also say that your existing usual customers will continue to occupy in the rooms. Therefore, for the other customers, you need to resort or allocate 900 rooms. So you need another. You are available. You are left with minus 900. So you are left with 1381.25. So this is available rooms. However, how much we needed? We need, break-even point is 1000 years, but it's for 2 days. So we need in total 2000 rooms for the quarter. So when I need 2000 rooms and I have only 1381, this project 1 is not feasible. Although project 1 is not feasible, still I am unable to decide that I should close the hotel because I am left with project 2. So that is another 4 marks that you will get on this. Last question, using the graph, quantify and comment upon the financial effect on project 2 on the ACCA hotel. Now if you look into the graph now, so this is D, you can see the fixed cost. How much is the fixed cost as per the diagram? 800,000. But originally the question told the previous fixed cost was 600,000. That means our fixed cost is increased by 200,000 because of the implication of the project 2. And then secondly, our selling price. If you see the total sales is 2 million, and actual number of units you sold, the rooms you sold, 8,000. So therefore, the selling price will be 2 million divided by 8,000. So the selling price is 250. Furthermore, if you look into your total cost in the question is 1,560,000. As all of you should know, we have one equation. Total cost is equal to fixed cost plus total variable cost. I know my total cost is 1,560,000 and my fixed cost we know 800,000. So therefore what we don't know is total variable cost. So the total variable cost will be then 1,560,000 minus 800,000. So how much you get? 1,560,000 minus 800,000. So your total variable cost is 760,000. How many units? The number of units is 8,000. 8,000 rooms. Therefore, we can calculate the variable cost per unit, which is 760 divided by 8,000. So that means So your variable cost is 95. Please note that variable cost increased by $35. Also selling price increased by how much? Selling price we calculated 250, but in the question 180, so therefore selling price is increased by 70. Now we can calculate the contribution. So selling price 250, variable cost 95. So then how much is the contribution? So contribution will be 250 minus 95, 155. So now we can calculate break-even units. How to do that? Fixed cost 800,000 divide by 155, you will get that. You get 5,161. Now, if we don't incorporate the project 2, my break-even unit is 5,000. But now my break-even unit is 5,161. So therefore, there is increase of 161 rooms. So then furthermore, but we can also do that we can go to the diagram, we can find out all this information. So I have the sales, total cost we got it, and then margin of safety. Safety will be, you have to take the given sales as per the to be used for the margin of safety, that is 7,300 minus 5,161. So 7,300 minus 5,161, 2,139 rooms. So upon using the graph, quantify and comment upon the financial effect of the, and then we can calculate the profit on this. So the total sales 2 million, total cost as we know 1,560,000. So we are making a profit of 440,000. So I think that's it. So with this you will understand all of the topics that we discussed here, and I will continue with another session in the next recording.